Hi everyone. Today we're gonna differentiate between the accounting profit and the taxable profit. So I'm gonna share my screen with you guys. And here in the taxable profit, we can say taxable profit is the income subject to tax based on tax laws. So it depends mainly on the tax laws. It is calculated according to the rules set by the relevant tax authority. And adjustment for tax purposes may exclude the certain accounting items. Again, it all depends on the authorities or the governing body who make the rules, who set the rules, that relevant tax authority. And now we can in the adjustment for tax purposes, like I said earlier, it may exclude certain accounting items. It can differ due to tax deductions, exemptions, or specific tax treatments. And now I'm going to show you the accounting profit. In accounting profit, it is the net income reported in the financial statements. So it is the net income or revenue after the losses or any expenses we share in the financial statements is the accounting profit. It is calculated using the accounting principles, example IFRS or GAAP. It includes revenues and expenses recognized under accrual accounting. It may include non-cash items like depreciation or amortization. So here's the one of the main difference between the accounting profit and this one taxable profit is the basis of calculation. In accounting profit, um, based on accrual accounting principles, revenues and expenses recognized when earned or incurred, and the taxable profit. Now we're gonna discuss like what the basis of calculation of the taxable profit. It is based on cash flows or the tax regulations, like timing differences or deductions or something like etc. So, in revenue recognition, the accounting standards may recognize revenue before it's taxable. It is in accounting standards. Example, revenue recognized on long-term contracts before cash is received. And taxable profit may defer this revenue recognition until the payment is received. So, let's say in accounting profit, I got the revenue of 100,000 and 30,000 is my expense. So profit will be my 70,000. But in taxable profit, same revenue, but tax laws allows a $10,000 depreciation reduction. So taxable profit is 60,000. That's it.
Hi, this is Pema, and today I'll be talking about why might a profitable company not have any income tax payable to the relevant taxation authority. In Australia, tax loss carry-forwards allow companies to offset current taxable income with past losses, reducing or eliminating income tax liabilities. This guarantees that financing firms with cash flow problems can maintain stability by paying lower taxes when they return to profitability, facilitating their growth and compliance with known tax law. The concept of deferred tax assets, that is DTAs, reflects timing differences between accounting and tax recognition, providing future income tax benefits for the companies. This is evident in BHP's $1.5 billion DTA in 2022, where exploration companies were capitalized and recognized for tax purposes sooner, thus lowering taxable income for some time. This strategy improves cash flow management, but it also indicates that there is a lack of harmony between the active income tax and the income tax reported, affecting the company's financial reporting. The research and development tax incentive in Australia encourages innovation and, in turn, reduces taxable income by offering tax benefits for eligible R&D. In a similar vein, the instant asset write-off encourages tax savings for businesses by allowing the immediate write-off of asset purchases. These incentives are intended to encourage corporate growth and innovation while also lowering taxable income, which is perfectly acceptable method of operating a successful firm without paying income taxes. In Australia, some types of income are legally untaxed from businesses. For instance, a form of grossed-up incentives that are meant to spur innovation, like R&D tax offsets. In the same way, realized gains from the sale of exempt or excluded property or assets like the primary residential places are not included in Australian income tax. These exemptions are in accord with policy objectives to encourage economic foraging and minimize tax exemptions in specific circumstances. Australian enterprises are international tax treaties to avoid double taxation impact on foreign income and minimize withholding tax.
Okay, hello everyone. My name is Xiaojun Chen. So today I will introduce and talk and tell us understanding the income tax expense and the different way the income tax payable. So in Australia, and the company reports income tax and expense well in their profit and loss statements, and the income tax payable where is the report on the balance sheet. So those and the figures and often different, and so that's why. Income tax expense and represent in the total tax expense for the year, including in the deferred tax adjustment, and income tax payable is the actual amounts on and order to the tax rate. Uh, so the different areas due to the timing different in the tax and the accounting adjustment made during the financial report. Okay. So why is income tax and expense and not equal income tax payable? Because income tax expense and account for the both current tax and the deferred tax, which may not yet be paid. For example, the tax deduction and the carryover in the loss and can delay the actual payment. So give us the example, and a company may be recording its expense of the 50,000 of the tax in the statement, but only on to the $40,000 immediately. So where is remainder as in the deferred tax liability. So to the summary, the income tax and expense and the income tax payable different due to the accounting adjustment, deferred tax, and the timing different. Uh, those is the understanding and the distinction about is then the different the reason. That's very important to financial analysis. So thank you everyone is the true attention. Yeah, thank you.
Hello, everyone. My name is Binghao Luo, and I will discuss how companies should respond to changes in tax rates. Specifically, I will focus on two major perspectives: financial reporting adjustment and strategic and operational implications. These are essential for ensuring compliances, maintaining transparency, and adapting effectively to such changes. Okay, let's dive into each perspective. The first perspective is financial reporting adjustments. When tax rates change, accurate reporting is critical to comply with accounting standards and ensure that financial statements remain reliable. And there are three key actions under this focus. First is recess deferred tax assets and liabilities. DTAs and DTLs must reflect the updated tax rates. This ensures they accurately represent the future tax effects of temporary differences. Second is recognize the impact on financial statements. Changes in DTA, DTLS, and current tax expenses need to be reflected in the profit or loss statement. If applicable, adjustments to equity should also be made. Third is disclose tax rate changes. Transparent disclosures about the nature and impact of the changes are crucial. This helps stakeholders understand how the new rates affect the company's financial position and performances. Now, the second perspective addresses the strategic and operational implications. Tax rate changes can have far-reaching effects beyond the financial statements, influencing decision-making and future planning. Here are the critical actions under this focus. Reevaluate tax-related estimates. Companies should revisit key judgments, such as the recoverability of deferred tax assets and any uncertain tax positions. The new rates could change these assessments significantly. Second is adjust cash flow projections. Tax-related cash flows impact budgeting, valuations, and impairment testing. Revising these projections ensure financial planning remaining realistic and aligned with the update rates. Third is communicate with stakeholders. Clear communication with management, investors, and auditors about the implication of the tax rate change is essential. This fosters trust and ensures everyone is aligned with the updated financial landscape. In conclusion, responding to tax rate changes requires careful attention to financial reporting adjustment and strategic and operational implications. By addressing these areas, companies can ensure compliance, maintenance, transparency, and prepare effectively for the future. Thank you for your attention, and I'm happy to take any questions.
To answer the question, would incurring a loss for tax purposes result in the recognition of a tax-related asset in the financial statements? Yes, it is possible. Losses can be used to offset future tax profits. This is the profit that we turn losses into an asset. This is called deferred tax asset. We refer it as DTA. The definition of deferred tax asset in ASB 112 is a DTA is an amount of income taxes recoverable in future periods in respect of deductible temporary differences, the carry forward of unused tax losses, and the carry forward of unused tax credits. A deferred tax asset is recognized in financial statements when a company has a reasonable expectation that future profits will be available to utilize these tax losses. Especially it represents the future tax savings. For example, imagine a company who is suffering from a really bad time, going through a tough year and incurs significant losses. If this company expects to become profitable again in the future, it can recognize these losses as DTA because they will help to reduce the tax liabilities once the profitability returns. But there are criteria to recognize DTA. Whether the company will generate enough taxable income in the future to use these losses. Let me explain this into really simple examples. There is a company A who is large in scale and having a tax loss of AUD 1 million in this year. However, expect to have 5 million income in the next 3 years, which is more than enough to cover to utilize the tax loss of 1 million of this year. At this time, we will recognize this as a DTA. We'll use the formula to calculate DTA. 1 million times 30% of the tax rate, which is 300K of DTA. For the company B, it's a startup small company who has a tax loss of AUD 500K, which is much smaller than that of company A. However, we don't have enough reason to believe that it will become profitable in the future, and the future profits won't be able to utilize the tax losses of this year. At this time, the DTA won't be recognized.